much smarter ways to make those types of returns and more without having to gamble, right? And these strategies are so easy, a caveman can do them. Swear to God. So we're also going to go over a state of the markets. Again, that means that we're going to review the entire situation of the markets, jobs, inflation, PCI, bonds, yields, interest rates, Fed, everything. You know, Matt Maley's the guy for that. Um, and what else do we have here? Full market analysis, stock and sector analysis. We're going to look at NVIDIA, see what's going on there as well. Of course, all of this is education, right? So make sure that you're paying attention and all that stuff. We have Kirk from Illinois. Go ahead in the Zoom chat. Let me know where you are tuning in from. I'm checking in from Hollywood, Hollandale Beach, Florida. And my name is Rodrigo. So very nice to meet you. If I haven't met you before, I'm here to help you, right? That's my goal. That's been our goal. Let me see who's in the chat. AJ Grimes, welcome. This is the first time. We got DC. I think I've seen you here before, DC. Edgardo Serrano, Ephraim, what's up, man? Frank Putman, never miss it. Frank Putman, I don't think Frank has ever missed a session for like the past 2 years. And look, there's a lot of learning here. Of course, we show you the strategies that we use to make money. Like that, you would want to know that, right? But again, the education is really what you can't miss out, right? Not just the education behind the strategy, but also the application of the strategy, right? It's one thing to know a strategy. Okay, yeah, you know, you buy a stock, it goes up, you make money. It sounds very simple, right? But actually applying that in real time, in the real markets, that's a totally different ballgame. Harry Sharma, first time here. John Montgomery, John Benner, Janet Stradling, longtime attendee. James Adams, I think I've seen you. There's a lot of James here. Kurt Keeter, member, we know that. Kenny Kofoworola, did I say that right? We got Marcin, Marco, Mildred. I know I've seen you here before. Ralph Williams, I saw you last time here. Randall, is this Lynn and Randall? Guys at the Lifetime people I signed up years ago. Always on the education side of things. I love that. That's the attitude. That is the attitude. You need to have the right attitude. Is that you, Randall? I knew it. See, I know people here on a first name basis, which you don't see that very often. Richard Davidson, Robert Thompson, Romel Espiritu. All right. So we have Richard from Alabama, Edgardo from Illinois, Romel from Canada, Email Ross from Texas, Randall and Lynn from Nashville, the Music City. Nice. James from Texas, Fadei from Phoenix, Arizona. Frank Putman, where are you checking in? helping y'all as always. So all right, guys, it is 6 p.m. Eastern. It is officially time to get rolling here. So I'm going to give people a minute or two to trickle in. Again, you don't want to miss the session. We're going to talk about a lot of things today. I put it on the docket on top. So let me recap here real quick what we're going to do. We're going to show you Matt Maley. So before let's backtrack a little bit, guys. Relax. Okay. Matt Maley, 40-year Wall Street veteran, chief market strategist at Miller Tabak. We're talking top of the totem pole, okay? The top analyst, probably the smartest person I know. And you probably have seen him on Bloomberg or CNBC, CNBC Asia, Yahoo Finance. He's all the time out there. And he's known for being smart and accurate and right, which is a good thing to be known for, right? So chief market strategist at Miller Tabak for like 15 years, something like that. He was director of trading at Merrill Lynch for about 12 years, around there. And Merrill Lynch is the investment branch of Bank of America. So it's one of the largest institutions in the world, okay? And now, when he was at Merrill Lynch, he managed Fidelity, BlackRock, and other huge firms. But keep in mind, Fidelity and BlackRock were the two biggest funds, mutual and hedge funds, in the planet at the time. So Matt Maley has plenty of experience to share, to teach, right? And show you how the pros do it. And prior to that, head of trading at Salomon Brothers, which was one of the largest trading desks in all of Wall Street. It was founded in 1901. It was bought out in the 90s. And I was doing a little bit of research, and their best years were in the 80s and 90s. And guess who was there in the 80s and 90s? Matt Maley. Is it a coincidence? So again, you have somebody here that has a lot of experience, and this is really who you want to listen to, especially, okay? Whenever we're seeing these meme stocks flying around. So now back to the docket. We're going to talk about short-term option strategies that actually work, okay? Compared to gambling on meme stocks, why you shouldn't be doing that, right? If you want 100%, 200% returns, you don't have to flip a coin on these meme stocks and try to fight the big guy. You don't have to do that, right? There's much easier, smarter ways to achieve those kinds of gains. Don't believe me? Look at these trades in front of you right there. 200%, 100%, 90%, 70%. We made money with UNG, GDX, SPXS, SQQQ. And again, the best thing about this is that these calls and puts that Matt is buying, because that's all we do in the inner circle with Matt. We buy calls and puts short term, right? These are very affordable. These are cheap options. We're talking 9 cents, 10 cents, 20 cents, 30 cents. This means that the trade will come out to $9, $10, $20 per the lot. So anybody can do these trades. You don't need a massive account to make these trades. All right. That's the whole point. So we're also going to review the state of the markets, what's happening, with inflation, with jobs report, inflation rates, the Fed, CPI numbers. I know some numbers came out today as well, stock and sector analysis. And of course, all of this encompasses trading education. So, all right. So we're all on the same page, and let me go through the chat here. Leo, first time. Okay. If this is your first time, please make sure you're paying attention. This is real stuff we're going to talk about. This is not Fugazi stuff. These are real strategies that we use every single day in the inner circle with Matt. So guys, I need you to put your hands together, get some claps rolling in, because if the claps are not here, you know that Matt's not going to come out. All right. We need everybody clapping. And I mean, everybody. One clap. Seriously, one clap. Come on. We need more than one. All right. I need to see more than that, guys. You see those hands hot. Come on. You can do better, guys. I need to see more claps. Come on. Let's be real here. Okay. All right. I like that. We're getting a lot of claps now. Now that's what I'm talking about. That's what I'm talking about here. So let's go ahead and bring on the man, the myth, the legend, 40-year Wall Street veteran, the man himself here, Matt Maley, chief market strategist at Miller Tabak. Thank you very much for being here with us, Matt. Appreciate your time. Again, great inspiration, people to learn from you, to hear you, especially during these volatile markets. And I'm really excited about the session today. But before we get started, Matt, There's a lot of people here that are watching for the first time. So maybe if you don't mind just giving us a little bit of a background of your experience, so that they can get a sense of, like, who's Matt Maley, right?
Sure. Thanks, Rodrigo. And welcome everybody. It's certainly a incredible time in the marketplace right now. And of course, what we saw today with the markets rallying very strongly to a new all-time high. Earlier in the week, we had these meme stocks, which are not really what people should be trading, because they're seeing these huge moves in for no reason whatsoever, just because somebody's short. There's no fundamental change. And what we try to do is focus on things where, on a consistent basis, where you can still make really good returns on things that are based on much more than just guesses. But my background is such that I'm, again, as Rodrigo mentioned, the first 25 years of my career was in trading. At Solomon Brothers, which was the biggest and most powerful trading desk on Wall Street. Other firms might have been bigger as overall firms, like Goldman Sachs, Morgan Stanley, but we had the biggest trading desk, and I was there for 15 years, and again, covering the biggest trading desks on Wall Street, and then 10 years with Merrill Lynch, and so a total of 25 years. In the last 15 years, I've been the chief market strategist at Miller Tabak, and what we've been doing there, again, it's combining all the things you learn from trading. I mean, most strategists are people who learn from a textbook, and they tell you what should happen over the next 3 to 5 years. And that's fine. I mean, we care about the fundamental outlook for the marketplace. But for those of us who like to, again, we all like to have, that long-term portfolio where we have things that, over the next 3, 5, 10, 20 years, and add those great long-term returns. But if you really want to maximize those returns, for those of us who like to trade a little bit more actively, we've been really successful at getting some real nice returns there. And again, we have to combine these other things. I mean, what should happen over the next couple of days? I'm sorry, over the next couple of years is not necessarily what's going to happen over the next couple of days or the next couple of weeks. I mean, we saw last year when NVIDIA, one of the greatest runs the stock any stock had ever had, and yet it saw a 20% pullback. We saw in 2021 where Apple Computer had one of the best years any stock had ever had, and yet it had 5 full corrections of anywhere from 10 to 20%. And you can take advantage of these issues on both sides of the ledger. And one of the things too that's really great is that we have the tools that only the big institutions had for decades, really. In the last few years, I'm sorry, really, well, a lot of these tools became available 10, 15 years ago, but really only in the last 4 or 5 years, they've become liquid enough and trade actively enough for us to take advantage of them. And that's the things, whether it be weekly options on all the big stocks and a lot of the medium-sized stocks. We have we have ETFs, options on ETFs, inverse ETFs, and options on all these things. And then we have them on commodities. We have them on the bond market. All these different things where we have the opportunity to play with those institutions that I've been covering for years and years. And when we were talking with Benzinga a few years ago, how can we level the playing field so that the individual investor can now take advantage of this? And the biggest thing I learned from all this background in the trading field, and again, pulling together not just those fundamentals, but look at technical analysis, looking at sentiment measures. And I will show you a great trade that we had recently in that. Positioning, when too many people are positioned on one side of the boat, and everybody's everybody's long and everybody's bullish, doesn't matter what their great long-term prospects are, how good their long-term prospects are, this stock's going to go down over the short term. Just the opposite. When things get really bad and everybody's bearish and short, the thing can do nothing but rally on a short-term basis. And we take advantage of those things. And now that we have the tools, but the most important thing is that we learned very, very quickly is when I was talking to all these trading desks around Wall Street, the biggest mutual funds, the very biggest hedge funds, we learned very quickly that none of these people trade alone. These people do it. They're the best in the business. They do it every single day for a living. And guess what? They don't trade alone. None of them do. Many of them have several dozen traders that they trade with. Others, maybe they just have 4 or 5 people that they trade with, but they all work on a trading desk, talking to each other all day long, figuring out what's going on in the marketplace and why. Not only that, they have every single broker on Wall Street calling them up. If they don't just have one broker like an individual has. They have Goldman Sachs and Morgan Stanley and Miller Tabak and Merrill Lynch, every single firm is calling them all day long. Hey, did you hear about this upgrade? Did you hear about this downgrade? Do you see what's going on in the news over, in the Middle East? Do you hear about there's a big suddenly a big downdraft in the oil markets? What's going on there? They are being kept up on all this stuff. If those people who do it, who are trading the big money every single day, if they're not trading alone, how in the world is an individual able to trade alone? So we've really tried to level the playing field so people can play with the big boys in a real way. So that's kind of
Right.
what my background is and what we're trying to accomplish here, and it's worked out real well for the last couple of years.
And one of the things that I want to highlight before we get into you explaining us and walking us through how you're able to get these trades in, especially the ones we just got today, it's that these trades, number one, they're very affordable. You don't need a massive account to do them, and more importantly, now that there's so many eyeballs on these meme stocks and things like that, it's the second time coming around. A lot of retail traders, like lost a lot of money when that happened, and again, we want to turn this into an opportunity to provide real education and show them that there's smarter ways to actually create additional income, for retail traders. You don't have to gamble, right? You don't have to be flipping a coin, correct, Matt?
Right. I mean, it's just, again, I don't know. There's some people are saying these meme stocks, they should do something about these meme stocks trading that way. I don't necessarily feel that way, but what I feel is that it's crazy. It's just complete guesswork. I mean, there are some tools you can use to try to get, but technical, when a stock moves up 130% or 160% in a day, there's no technical analysis that's going to help you. A higher high, higher low. It's like, of course, it's making a higher high. It's up 160%. I mean, where do you sell? Where do you flip the switch and go the other way? We actually did have one person come in yesterday in the chat room and said, "What do you think?" On GME, I think the stocks are getting out of control. I'm thinking about buying some puts, and I told him, I think, it's ridiculously overbought. It could turn down at any time, but I don't know where. I'm not going to touch it. Well, he did, and sure enough, he made some money as the stock went down. He timed it really well, but it was complete guesswork. And if you're trying to do that all the time, it's like trying to trade alone. You're just guessing, and we try to form stuffs. And I'll show you a bunch of trades that we've done just in the last week or two that have worked out extremely well because we're basing it on probabilities. Certainly not every trade works. In fact, the trades today, we had some bets on the marketplace that the market would go down today, that the inflation number would be bad, knock the stock market down. But thankfully, we hedged it in a number of different ways, and so we were able to make money and make up for any kind of losses we had in those bullish bets. That's the whole idea. Risk management, making money. I mean, we're not here trying to make you $1 million in a month, okay? We're trying here giving consistent trades every month that can make real good profits. And sometimes those profits are 20% or 50%, but many times a month we get it in the multiple hundreds of percent. And it really works out well and really helps people maximize their returns.
Right, and Robert Baumgartner is saying shorting GME on the pop today was one of the easiest, most confident trades I ever made. So yeah, Matt. So if you want, you can go ahead and take over the screen. Walk us through, because I see that you were trading here UNG, GDX, and that's one of the things important to highlight. Most of the people that are out there, all they know is Google, Facebook, Apple, Amazon. Now, Matt Maley is looking at the overall markets. I think we even made money with the Japanese yen, and we've made trades with no Forex, everything with the stock market. And one last thing here with the meme stocks. It's funny because last time this happened, Matt, didn't you make like 5,000% shorting Viacom, buying puts?
Well, that was the thing. We went in with Viacom. Again, it just got so ridiculously overbought with Viacom, which is now Paramount, and it's split off into other things. But it was during the meme stock craze, the first one. And the stock had, we'll show you this again, this was most overbought I'd ever seen any stock ever. So we went in, sure enough, the stock went down 63% in one day. I'm telling you, their fundamentals didn't go down 63%, but we took a position on a bunch of options. We sold half of them up about 2,500%, and the other half 5,000%. So we do take advantage of them when they get incredible. When they get incredibly overbought or incredibly oversold, we did even better on a trade on the Chinese stock market the next year. So, but the point is, we're trying to take advantage of what the market gives us, and the market gives us a lot. And just trying to bet on some meme stock, and I think this meme craze is going to die down very, very quickly. A big part of it is that nobody had anything to do. For last week, at the end of the week, the volume on the QQQs and the SPYs, the two index ETFs, had just fallen off a cliff. They were lower than most holidays. In fact, there were only 2 days. There were only 2 days, four days in the last 2 years where the volume was lower, and 2 of those days were half days, the day after Thanksgiving. So everybody was sitting on their hands, and suddenly these meme stocks started rallying. And so instead of all these fast money traders trading 10, 20 different stocks, they had 2 stocks to trade, 3 stocks to trade. And so all of them went in for the one thing. And they were just because everybody was sitting on their hands waiting for the big inflation number today. Well, that inflation number's out. Now the stock market's going back up, and all these guys pulled out of those meme stocks, and they all got absolutely clobbered today. And those who have been chasing them got their heads handed to them. So anyway, I didn't mean to get off on a tangent there. But I just want to call a couple of things. The first one I'm going to tell you about was actually a trade we did last week, and it was on copper. We had been bullish on copper, and one person in the one really good great guy and a very smart trader in the chat room, and it wasn't, he was kept showing, hey guys, we got to look at copper, so I'm going to say that's one of the greatest things about our chat room. It's not just me giving these ideas out there, it's many other people. But we looked at copper and we realized that it was working real well, and we really liked it. However, it was coming to a point where it was getting way too overbought. And let me show you something here. Boom. Boom. Okay, what happened was, I'll show you what we have here. And we saw this big, huge rally in copper. It was kind of a short squeeze there too. But what we looked at here, this is right back in here, it had become overbought, okay? And you see this is the RSI, the relative strength index. And the Benzinga likes to call it the money gauge. But we come in here, and we what it is it gets up to that the 80 level, that red line. That means stop, don't buy it anymore. It's getting overbought. If it gets down to the green line, it means it's getting oversold. Go ahead, buy, go ahead. We can see how it got very, very overbought. But let's look at this thing here. I just want to go over what happened was. So this was something, and it just tells you about how we use it. We were bullish on copper. We thought copper would continue to go higher, and we were right. But it had become so overbought here on it. Look at its weekly RSI. Now this was a couple, 2 weeks ago, a week and a half ago, right in here. Now it's gotten even more overbought. But something else I had from 40 years experience, I looked at this thing that we look at, which gives you the bullishness, gives you sentiment. Okay, I don't care how good the fundamental prospects are for copper, and they are really good. I mean, Stanley Druckenmiller was on a week and a half ago, 2 weeks ago, talking about how bullish he is on copper because of all the things, AI and all these different things, and he's wildly bullish on copper. And so I'm going, here's one of the smartest traders ever to live. Okay, smartest hedge fund managers ever to live. He's bullish on it. The problem is it's way overbought, and the sentiment showed that was over 90% of futures traders were bullish on it. There was nobody left to buy it, okay, on a short-term basis. So what did we do? We came in and we bought Freeport-McMoRan, okay? And the old name for Freeport-McMoRan was Freeport-McMoRan Copper and Gold. Okay, copper. Okay, so I knew that on a very short-term basis, this stock was going to get hit. Well, sure enough, we came in right in here. Right, you see, here's the price right up here. And it was overbought, and we bought the puts on it, and we only held them for a couple of days and made 200% on those puts. Then we got out of them and said we think it's going higher again, and sure enough, it rallied right back. Okay, so this is in copper. When was the last time you traded copper? Okay. We took advantage of the situation in copper because we have the tools. In the old days, 10, 15 years ago, you'd call up the Chicago Board of Trade. I want to open a commodities account. I would like to trade copper. Who are you? How much money do you have? No. We have ETFs so we can do it. Okay, we don't have to go to these fancy things. We just went in and traded in this case, we just traded one of the stocks in the area. But other ones we've had this week was gold. Okay. We saw how gold, okay, and again, this was a different situation here where we used technical analysis. I've been bullish on gold for a long, long time. Okay, and we've been riding it up really nicely. But see how, remember that RSI chart that we talked about, right? Look how overbought it got in the middle of April. And I said, we got to walk away from this thing. It's getting too overbought. And so we walked away. And we still owned, and I said, don't sell your gold shares. I still own Barrick Gold. And I said, I'm going to hold on to those, but it's because that's my long-term play. It's the shares. It's not an options play. It's the long-term play. I'm going to stay away from it. So then it worked off. See how we got through into early May here, and it became oversold. So let's get rid of this RSI chart. It's all right. It didn't become oversold. I take it back. I don't want to misguide you here. But it had worked off that overbought condition in a nice way. And I realized it didn't have to get oversold because we love it. The fundamentals are really good. We just needed it for all that enthusiasm to die down a little bit on a short-term basis. So what we did, let me get rid of this RSI just so you can see everything a little bit better. So we'll take that away. And then what happened was we came in here. Let's blow it up a little bit so you can see it better. You see right in here, it started making a nice base. I'm sorry. It's after going down for a while, it started making a nice base right in here, right at the beginning of May. And we like that. So then we tried it. We looked at another issue. This is called the MACD chart. And let's see if I got it. Let's see if, no, it's not going to let me do it. I'll do it again. Hold on. Okay. So I'll just bring it back up. Oh, it takes a second. And what this is, instead of telling us something is overbought or oversold, it tells us when the trend is changing. After it's become oversold, is it turning up to the upside? And see how we got this, what's called a MACD cross, positive MACD cross. So we got that earlier this week. We still think it's got more to go, but it might take a breather tomorrow. We'll have to see. So we came in and we bought the GDX GDX calls. Okay. And what are the GDX? Well, the GDX is the ETF for the miners, for the gold miners. I mean, I had turned really bullish on the gold miners back earlier in the year because they had been underperforming gold. And I knew once gold broke out above its key resistance level of just above 2,000, that I knew that the gold stocks, the gold miners would play catch up in a big way. But see this again. See how you see here? This doesn't, it's a nice positive cross for the white line. And what it is, it's kind of like the golden cross when the 50-day moving average crosses above the 200-day moving average. Okay, when you get that positive cross here, that takes it higher, and you think, well, that didn't really take gold that much higher. Well, if you shrink this down, you can see it was a very nice rally in there. We took advantage of it, and more recently, we saw the MACD cross taking place again. So we went in and we bought those gold shares. Same thing here. So see the MACD cross there. It doesn't look like much of a rally, but when you bring this thing back down, you can see it actually was a very, very nice rally. So I now remember that one. I'm going to show you what we did, the exact thing in the options. But the other commodity we did was natural gas. And we looked at the underlying commodity. Oh, I don't get too much into the weeds here, but I just want to show you how well you can look at these things. Natural gas have been acting like dog do for a year and a half. They've been doing nothing. I think it's something so slow there. I'm sorry. But you can see how it's been going down. 2021. Okay, let's get rid of some of these things so the chart doesn't look so darn busy. Let's get it here. Take that away. We'll take that away. We'll take that away. Whoops, that away. Oops, I want the RSI back. And we'll get rid of the bond. Okay. Actually, I'm going to take the RSI out and I'll bring it back in a second. Okay. Now, what we have, let me bring it up so you can see it. But again, I'm going back in 2021. Bang. Gosh, my screen's a little bit slow, so I apologize there. But see how much it got, obviously just got absolutely crushed here in 2022 and 2023. But even this year, as we moved into this year, or late last year and early this year, boom, you see how it's been going down. But then what we noticed was becoming very, very well, let's bring back the RSI. I'll bring that back. And you can see how it had become very, very oversold here in that RSI chart. Again, see that? Earlier this year, but it still wasn't bouncing much. It was stuck in a sideways range. And what we noticed, though, that this was building a very nice base. See how it got to this level? The buyers kept coming in at the same level. So once once that base was broken to the upside, which happened earlier this month, we knew that they were going to go higher. So we came in and we bought the UNG. What's UNG? That's the ETF for natural gas. So we bought that, and we made some real nice money. So let's go to the videotape. Is Warner Wolf? Although some of you guys are a little bit closer to my age, will know who Warner Wolf was. But let's go over to this situation. Rodrigo, can you still see my chart, my screen?
Yeah, SPXS.
Okay, good. Let's. I will show that in a second. But here are the two shots. I'm going to blow it up a little bit. So this is what we did. Here we are, GDX. Okay, we bought these things. We came in. We bought them here late last week. Okay, right here. If you see my arrow there going around, and then we bought them again later in the day. Okay, so then today when they were up nicely, and the thing was, my experience, I knew the market rallied, gold went down, and people are saying nothing's working today. We had bought some puts. We made some negative bets, and those aren't working. We bought some positive bets on natural gas. Whoops, natural gas. Let me go back to the gold. Those aren't working. Oopsie. Okay, and nothing's working. I said, relax, be patient here. Okay, and because the other thing too is that the market wasn't rallying, so we weren't making money in our hedge either. It's like, what's going on? Nothing's going on. Be patient. We stayed patient. I knew from my years' experience we needed to stay patient. Sure enough, natural gas bounced very, very nicely. And I mentioned, we bought some of it here. Okay, our average price, okay, was right in here, and it was when it was up 70%. We sold it up 103% from the low where we bought it last Friday, and up 70% from our average. Suddenly we're making some nice money. Okay, we're not making gazillions of dollars but we're making real nice money. Okay, so we almost double our money, and we still hold them. So we only sold some. And they rallied for the end of the day. We're holding some more because again, they're coming out of that big oversold condition. What happened to GDX? The GDX calls we bought late yesterday because they were breaking out. Sure enough, up 50%. We sold some of them today. Didn't sell all of them, but a nice little rally there. But what we also did was hold on to the bullish options in the stock market because, sorry, let's just turn that off. Sorry about that. So anyway, so what we had is, as I mentioned, we had some bearish bets, but we had some bullish bets as well. So we came in and we bought these puts. Now you say, well, wait a minute, puts, how is that a bullish bet? Well, the SQQQ is an inverse ETF. It's the 3-time leverage ETF for the QQQs, right? So if you buy calls in the QQQs, okay, that's a bullish bet. But since SQQQ is an inverse ETF, you actually want, because it will go down. It will go down when the market rallies. Therefore, you want to buy puts because the puts will go up when the market rallies. Now, I hope that makes sense the way I explained it. But anyway, we came in here, we bought those, and look at them. We bought them here, right in here at the end of the day yesterday, and they were down. We bought them for 2 cents. I'm sorry, but the 2 cent trade. I'm sorry, these were the 4 cent trades. Okay, but look at them. These things traded. I'm sorry. So we paid 7 cents for them. I'll show you the other one. We paid 2 cents. We paid 7 cents. So that meant it cost you $7 to buy one option. $7. That's it. So we bought a bunch of them. Okay, because we could buy 10 of them, and it only costs $70. You don't need this huge account with $200,000 in it or $1 million in it to trade these options. You only had to buy there was $7 for one option. So we bought a bunch of them. We sold some of them when it was up 100%, 99%. I was actually up 100%. Then as it got higher, as we got later in the day, we sold some more, up 200%. Okay, so our average price is up 150. We actually sold some up 150% as well. I just didn't put that in there. But our average price is about 150% gain. So we have made more than double our money. We do leave a small amount by the end of the day, but very small amount. But there's a real nice thing because again, risk management. We don't just buy them all at once and sell them all at once. Once you buy them, especially once you've sold half your shares up 100%, that means you cannot lose. You've covered what you put into it. Now you can afford to be a little bit greedy. We sold a little up 150%, but we held out to the end of the day to make 200%. But what we also bought at the same time, that was the options on the QQQ, which of course is the NASDAQ. We also bought options on the SPX. Okay, this is the reverse of the inverse ETF for the 3 times leverage ETF for the S&P. So we did some on the S&P and some on the NASDAQ. Well, sure enough, here these came in. We bought them right here at 2 cents, and they were doing nothing at the beginning of the day. It's like, well, they were trading at 3, but they weren't really trading much at 3. And people are saying, oh, and then the market started, it would rallied up and then went all the way back down to almost unchanged. And people like, should we dump them? Should we dump them? Like, no, relax. They're going to be fine. Okay, this news out today is positive news. We don't need to be guessing on what's going on in the meme stocks. We know from what's going on in the marketplace, what's going on. We were looking at the bond market. Bond yields came down a big way. There was no way the stock market was going to roll over in a major way. So we held on to those calls. Held on to the bullish trade in this case because they were puts, because of course they were an inverse bet. But again, we held on here. They started going up 4. We did sell some at 4, okay, up 100%. But at the end of the day, we were selling a bunch here, up 200%. We kept a little bit, tiny amount. But you can see another situation where we made tripled our money. I mean, up 100% is double your money. Up 200% is triple your money, right? So we tripled our money, more than tripled our money on 2 different bets today, plus made 50% on our on the gold trade, plus made 70% on the natural gas trade. So we can see where we're making all these different kind of trades. And then even though we had some bets that the market will go down, this more than offset it and really we're able to make us money. And again, using our heads, using technical analysis, using, we know fundamental, we think copper is going higher, but short term we're going to make the negative play. But we love to play on natural gas because it was breaking out. We love to play on gold because it was breaking out. And we combined all these trades to make educated guesses on real breakouts, not just some meme stock that goes up 160% because some guy sent out a tweet that he hadn't sent out for 3 years. Again, I hope that gives you an idea, but I want to just go on a couple things just to show you a little bit more about just some plays that we had. And here's some nice ones we made in May. Here's some great call plays that we made in April. And again, here's one where we see where we made the excuse me here. Where did I have it here? I'm sorry. Yeah, the April Fool. We said SQQQ. Look at this. Back in the beginning of April, wait a minute. Which did you buy? The puts or the calls? Well, the first thing we did is we bought the calls, thinking the market will go down. Remember, the market sold off in April. We made 570% on those calls. After we made the 570%, we flipped the trade and bought the puts. Okay, and made 90% after we'd already made 570%. So these are the types of things I just wanted to show you that it's not just once in a blue moon. We got these trades and on a more active basis, and I can give you plenty of examples from March and other months, January, February, March, etc., where again we've made these nice plays.
Yeah, and we're going to talk about also the Tuesday meeting, but really quick, I'm getting bombarded here with questions about the inner circle, Matt. I'm going to go over them real quick. These are questions from the live viewers, and we'll go over these questions. Then we'll move on here into the next segment where we're going to talk a little bit about the overall state of the market, individual stocks, the juice. All right, the juice, but I do need to make sure that I answer these questions because they keep coming. All right, so. Questions about the lifetime. Okay, for the lifetime, you got to call me. Just call me. We'll go over the details, or I'll post them on the chat. Okay. Next question: is this good for beginners? 1,000,000%. Yes. These are simple calls and puts. You don't need to have special permissions, level 2, 3, 4, 5 on your brokerage. This is the most simple type of trade that you can make when it comes to option. It's the same concept as buying a stock. You buy it, you sell it. That's it. So these are beginner-friendly strategies. And of course, not only is it beginner-friendly, but we're holding your hand because you're getting entries and exits, okay? So, and you can also do paper trading as you learn. Keep in mind what you learn from Matt Maley. As you learn, you will be able to improve your own trading. And while you learn, you make money with his trades. It is a win-win case, right? Next question. What is the schedule? Great question, Mark. So, the chat room, the inner circle is open 24/7. Keep in mind, we have members in over 120 countries. So we have a global community. I've signed up people from every country you can think of. And again, so the inner circle is open 24/7. However, Matt Maley is there from 9 to 5, Monday to Friday, with the members, chopping it up with them, talking about the markets, answering questions, giving market commentaries, whatever it is. I mean, this is Matt's community, okay? And our goal is to help you become a better trader. We don't just say it, we do it. And that's why you have access there. And not only you can learn from Matt, keep in mind, we launched these inner circles. I launched it here with Matt about 4 years ago. So we have members that have been with us for over 4 years that have become beasts in trading, and they have learned so much from Matt. So you can learn from the other members as well, right? Now, next thing, we do have, and Matt's going to talk about this a little bit before we get into the market conversation. We do have a meeting every Tuesday from 11:30 to 1 p.m. And basically that is a full meeting breaking down the markets, talking about everything: bonds, yields, interest rates, jobs reports, market price action, everything that is happening around individual stocks, trades, setups, everything, technical analysis classes as well, talking on patterns and moving averages, RSI, MACD. You're listening to Matt pretty much go over all this stuff. And that goes on for about maybe 30, 40 minutes. And then the next segment of the meeting, it's almost like an open Q&A where you have direct access to talk to Matt, ask him questions in the live video call. Okay, keep in mind, you already have that access in the inner circle from 9 to 5. Okay, the video call is a bonus. It is an extra layer that we added on to provide more assistance. It started out as a meeting, 15 minutes, and then knowing Matt, how passionate he is about the markets and helping retail traders, it basically turned into a 1 hour plus meeting. So next question, Jeremy, is this good for small accounts? Absolutely, absolutely. Yes, Matt has strategies for all account sizes. Keep in mind, these contracts are 9 cents, 20 cents, 30 cents. Comes out to $9, $10, $20 for the options lot, right? So you don't need a massive account or anything even close to that to make these trades, right? So next question, is this just for option trades? So it is for options trades because we're trading options on the SQQQ, TQQQ, or commodities like UNG or GDX. But ultimately, for the most part, it is on most of the trades are on SQQQ and TQQQ. But the whole point of this trading is volatility trading. So like I mentioned earlier, we made money with trading options on the Japanese yen. Okay, that doesn't mean we went open a Forex brokerage account and bought the currency. No, we did that with the stock market, and we've never even traded that before. Why did we do it? Because Matt spotted an opportunity that we could take advantage of. And that's one of the benefits of having a very smart person on your corner that knows and is able to recognize these opportunities so that we can take advantage of them together. Now, if you're learning stocks while you learn the options, you can also just buy outright the ETF, SQQQ and TQQQ, right? And that's as you learn the options. And let's be real, guys, there's not much to learn. It's very simple, straightforward. You buy a call, you make money if the thing goes up. You buy a put, you make money if the thing goes down. It's not rocket science. It's very simple. But while you're learning that very simple stuff, you can just buy the ETF itself, the SQQQ or the TQQQ. Separately, you're going to get 6 hand-picked stocks from Matt, 6 per month. And these could be swing trades anywhere from 2 weeks to even 2-3 years, saying, hey, you know what? I really like this stock long-term. Great fundamentals, great company. And ultimately, you want to trust Matt when it comes to actually analyzing a company. Next question. Can you make these trades with any brokerage? Yes, you can make these trades with any brokerage, even if you live outside the US. So no excuses. Next question. Does Matt provide, we have to go through this, Roger, too bad, sorry. I mean, these are questions from the viewers. Next question. Does Matt provide entries and exits and holding periods? Yes, Matt provides entries and exits for every single trade along with the specific contract that he's buying or selling. Matt's holding periods are anywhere from 1 to 3 days. So these are short term. And last question we have here is there a money back guarantee on all the packages? Yes, all the packages have a 30-day money back guarantee. Now, Matt, anything that you want to add on before we move on here to the next? Oh, the last one, the alerts. You get push notifications sent to your phone. So every time Matt buys or sells, you will get notified immediately. So, Matt, anything you want to add to that?
Well, yeah, well, number one, just to reiterate what you said about the specific trades. I mean, again, we got certain things where, hey, it looks like natural gas, or we think gold's breaking out here. Good luck. We say no. We want to buy GDX. We want to buy, and we give you this. Like in this case, was the SPS. Well, I'll just go back to that. Hold on. See, we get GDX, the May 24th, the specific option, the specific expiration date, the specific strike price, obviously whether it's a put or a call, and and the same thing with the SQQs or UNG, whatever. There's those specific trades, and you get them as soon as we do them. I mean, and as Rodrigo said, we get those on a you'll get those push notifications. So if you're out to lunch, or if you're working, or you're doing whatever you're doing, you're going to get those sent right to you. The other thing is that the meeting we have on Tuesdays, people find it very, very, very helpful in terms of education. I mean, the whole idea is helping people understand what the heck they're doing, so they can, a lot of people get started, as Rodrigo said, doing the ETFs before they do the options, and other people will do the ETFs, and then they'll do paper trades, do a paper portfolio. Whoops. When you have what happened to my oh, can you still hear me there? I just wonder if
Yes, sir. Yes, you're good. You're good.
Okay, good. It looked like my Bloomberg just went out. But I'll have to bring that back up. But anyway, the situation is that
All right, I think Matt froze there for a bit. He should be good to go. Here in a couple seconds, he should come back. Manuel's asking. All right, you're good with the connection. We lost you there for a minute there, Matt. Should come back anytime. You there, Matt? Are you moving? Can't see you.
I don't know. I didn't hit any buttons, so I didn't know what the heck happened there. But anyway, okay, good. I got a little word there. But just to go back, what we were saying is that it's just it's a great group of people. We have a lot of fun. We razz each other every once in a while about our sports teams and things like that. But it's a great team effort where people are working, and if people will call up and say, hey, this is going on with Robinhood, with my Robinhood. Anybody know how to get? I don't use Robinhood, so I don't know. But people say, oh no, hey, just do this or do that, or call this person, whatever happens to be. So it works out really well. But yeah, I'll just leave it at that. But it's just that call. I think people, and of course it is taped, and you get it. People it goes over an hour. I don't have it over an hour. I'm working, or I'm having lunch, or I'm great. It's taped. Within 5 to 10 minutes after the meeting's over, it gets sent to you, and you can look at it at your leisure whenever you want. So it's but very, very, I think that's a very, very helpful thing, and you can ask the questions later in the chat room. So that's really
right.
I think a really beneficial part of what we do.
Great stuff there. And by the way, the link's going to be in the chat. So everybody's anxious. Everybody's here ready to hear you, especially Roger, very excited to hear from you. So let's go. We went over some of the trades, and now talk to us a little bit, Matt. Now that we went over some of these questions from the viewers, talk to us a little bit more about overall, like as a chief market strategist from your perspective, what, markets are at an all-time high today, right? And CPI numbers came out. Overall, big picture strategy. I'm sorry, just big picture overall. Your thoughts on the markets and everything within bonds, yields, interest rates. We'll touch on inflation and jobs report after that.
Right. Well, let's just look. I want to show. I mean, one of the things is when the market breaks to a new high, that is usually very good. And the problem though is that on a near-term basis, a couple things. Number one, remember we talked about that RSI chart. Remember the RSI? Oops. I want to get rid of the volume. Sorry, just so you can see it. These Bloomberg charts get so much stuff. But here, and I'll pull this up a little bit. Now it's great that it's making a nice, slightly higher high. But again, it's starting to get overbought. Not crazy overbought, not as overbought as it was in December, and even that didn't follow by much of a pullback. But it's getting overbought, so we need to be careful here on that RSI chart, okay? And the other thing I just want to look at, I want to show you something that we showed today. One of the people in the chat room said, well, what's it, doesn't the market sometimes make new highs and then it's followed by a big reversal? Well, actually, yes. Not, not always, but certainly most of the time when it makes a new high, it keeps on going. But I just want to show you this here. I mean, all you have to do is look at this. And whoops, let's get rid of all this stuff. Get rid of that. Get rid of that. And look at that. Okay, you see that right there? Right there, nice little higher high, barely higher high, and then look what happened. Market got absolutely crushed. So you got to be, we need to be a little bit careful here, especially because the market is very, very expensive. And we keep, you listen to this stuff on some of the outlets, and there's a lot of really good people who are interviewed on CNBC and Bloomberg and Yahoo Finance and the Schwab Network, what have you. There's great people, but some of them that you just wonder what they're saying. They just say stuff, and I'm like, okay, market's not expensive. Well, it is expensive. I mean, it's at almost 22 times earnings now, and that is expensive. More importantly, it's expensive on sales. You can't fake sales. Okay, it's your sales are your sales. If you have earnings, you can do all these charges and write-offs and things to make them look better than they really are. You can't do it. Sales are sales. It's trading at 2.8 times sales. That is more expensive than we were at 2000. It's at the top in 2000, more expensive than it was in 2008. So what do we need? We need earnings to be better. And people say, well, earnings are good. Well, yeah, they're going to be up 10% this year. But, people try to sit there and they say, well, earnings growth, earnings estimates are moving up. They're not moving up, okay? They're moving up for the second quarter, but not for the third and fourth quarter where they've come down slightly, okay? The whole year has not moved at all. Remember, last year, the stock market went up 25%. How much did earnings grow? 0, okay? So now we have a stock market that's up 37, 38% from the beginning of 2023, on earnings growth, it's only been 10%. And interest rates have come down. They're still higher than they were, and there's only been literally 6 or 7 weeks in the last 17 years where the long-term bond yields are as high as they are today. So yeah, they're not as high as they were at the absolute high last October, but they're still much higher than they've been for the vast majority of the last 17 years. So if we have earnings that are not playing, shows the market is expensive, we have an economy. I mean, the GDP numbers are lower. Look at this here. I'm not trying to scare people. The way the market has been acting lately, there's a lot of reasons to think the market will go higher. There's liquidity in the system, but we need to be careful. Okay, look at this right here. Look at this big sell-off. This is what it is. This does not measure the economic growth. It measures it's called the Citi. It's offered by Citigroup, and it tells you how the economic data is doing versus expectations. Well, in the last month, the vast majority of the data has been missing expectations. So that means growth is starting to slow down. How are we going to get better earnings growth in the second half of the year, which are supposed to grow 16% in the second half? When the economy is showing, there's a lot of resilience. The consumer is showing resilience, all this other stuff. But we need a lot better growth than 10% earnings growth. So we need to be very, very careful here, especially with the stock market becoming overbought, at least on a short-term basis. At the end of the day today, we actually came out and bought some more, made some more negative bets. It wasn't a big play, but the S&P is up 9 out of the last 10 days, and the 10th day was only a sideways move. The NASDAQ 100 is up 10 days in a row. So in other words, they're getting ready for a pullback. Even if the market's going to go a lot higher, they should pull back a little bit over the next day or two. But we'll see. Again, not trying to back up the truck, but we need to be careful. We have we have a lot of momentum in the marketplace, but we just need to be careful about chasing. The thing, though, is that we have these issues. The thing that's very positive about the market, of course, is the level of liquidity. And people keep saying, the economy is driving the market higher. It's like economic growth isn't that good. It's not bad. It's solid. Okay. And if the stock market was trading at 17 times earnings or 50, especially if it was trading at 15 times earnings, I wouldn't be worried about it. Right? But the economy is growing fine. It's not great. It's not gangbusters. Earnings growth is fine. 10% earnings growth is usually be really good. except for the fact that last year was zero. So combined over the last 2 years, we've only had 10% earnings growth. So average of 5% a year, that's suddenly it's not so good, right? So what's going on here? We have this massive amount of liquidity that's going into the market, and people don't realize that this liquidity that we've seen over the last for a very long time, but since the great financial crisis. I mean, it's not a coincidence that every time we have a mini crisis, they pump liquidity in the system and the market rallies. I mean, what happened in 2019? All right, we had the repo market started having big problems. The Fed did a QE program. I refer to it as the not QE program because they kept saying it wasn't QE, but it was. I mean, they were buying bonds, and the market rallied right into the pandemic. And everybody was warning about the pandemic, and yet the market kept rallying. How could that happen? Why? Because the market were flooding the system with liquidity. What happened last spring, when the regional bank crisis took place? They flooded the system with liquidity so that banking crisis didn't become a run on the entire banking system, and the market rallied, even though we were in the middle of a banking crisis. Right now, AI obviously played a big role as well. So I'm not trying to say it's only liquidity, but we've had liquidity injections again the last couple of years. We saw it last year when the Treasury Department changed the way they offered securities to go to much shorter term securities. That created a wave of liquidity in the marketplace. After the tax law, the tax things came in, the tax receipts came in April. That created a push of liquidity. That may last until the election. Who knows? My feeling, though, is we'll probably see a little bit of a pullback right here. Again, market getting overbought. That liquidity flows can't last forever. And we'd also know another thing here is that we have the bond market, which has seen a nice rally. Of course, if the market rallies, that means that the yields have come down. Let's see how the yields. Now we're getting down. We're testing that 200-day moving average on the 10-year yield. Oops. There we go. And you can see how we've dipped below it a few times, but each time we've dipped below it, it snapped right back. So what's it going to do this time? And again, it's not really oversold, but you can see how it's testing that 200-day moving average. On a very short-term basis, everybody's looking, oh, the market's breaking new highs, everything's hunky-dory. There's a good chance we'll see a pullback over the near term. The other thing, of course, we have to be very worried about is the price of oil. And people say, well, the Biden administration is going to put a lot of pressure on the OPEC and the Saudis and these people and other members of OPEC to try to get oil prices down for the election. Well, that might be the case, but what we have to watch is that, first of all, the Saudis have a lot of reasons why they want to keep oil higher. Aramco, that's the national oil company, right? Well, guess what? Guess what? They have announced a secondary offering, right? They're going to sell shares. And do you think the Saudis are going to want for their national oil company to sell shares over the summer? Do you think they want oil prices down? No, they want oil prices back up so that they can sell these at the best price and get the most money they can from it. And so that's number one. Number two, we saw oil inventories today. They were lower than expected. So the economy is showing that the demand for oil is strong. Okay, so that helps. And then we'll look at this here. I'm going to just show you here. Let's get rid of some of these things so you can just see it a little bit better. Remember, we talked about that RSI chart. Point. Oopsie, sorry. Got the wrong one. There we go. But see how it got oversold earlier in May? Now it's trying to bounce back. And what we're watching again is that 200-day moving average. But more importantly, you can say 200-day moving average, but look at this key. Look how important the $80 level is for crude oil. And again, the Saudis want oil back up above $80. I think they want it well above $80. But look how this $80 level. See that green line? Let me get rid of the moving average. Okay, go away. Go away. Okay, there it goes. Okay, there we go. 1, 2. See how it keeps bumping up against that? When it finally broke above it, it rallied nicely. Now it's come back down, but it's only dipped slightly below it. If it can regain that line, that key resistance level, it's going to run up easily into the mid 80s, maybe higher. And then again, of course, we have the situation in the Middle East. And I'm not, I don't, when I talk about politics, I don't, I have my opinions on politics, but my opinions don't mean anything, shouldn't mean anything to you. But what we do care about is what is going to happen. And if it is going to happen, how is it going to affect the markets? And right now, there is little question that Israel is basically going to do what they're going to do. And they've been saying it right from the start. They want to wipe out Hamas. Does this mean it's going to become a regional conflict? I don't know, but it's not. It's been continues to escalate. And we had one, 10-day ceasefire. This thing continued to escalate. And, they're out there saying now, we're willing to go it alone. We'll do whatever we need to do. It sounds like they're going to stick by their word. And so, again, I'm not betting on that to think that, because if that happens, well, if it becomes a regional conflict and Iran really becomes a big problem, I mean, in other words, if the Strait of Hormuz closes down, oil prices are going to shoot well above $100, and it's going to work very well. But what we're watching for, I'm not making bets on that geopolitical thing. I'm not a geopolitical expert. What I do know is that Israel has said everything what they're going to do, and they have not backed off. Why would they back off now? My biggest concern is that their real motivation is to get Iran and make sure that they don't become a nuclear power, which has been their goal for 30 years, and they've done whatever it has taken to make sure that doesn't happen. And Iran is getting closer to becoming a nuclear power, whether we like it or not. But anyway, watch this oil play here. Oil prices go up, that's going to clobber the market, but it's going to be real good for the energy stocks. And so I've been pushing some of these stocks lately. And remember, we talked about natural gas and how that's trying to break out. And if this oil price can break back above $80, we're going to make a nice play. So it's not going to be everything that goes down, but we're going to play it in the energy stocks. If it fails and we do break down here, we'll have to shift our thinking. But right now, we move back to the positive side. Now, again, we try to tell people why are we doing things? I mean, a certain thing happened this year. You see how this is crude oil, right? See how it made a low there? Look what it did in January. It made a higher low, okay? But look at the XLE, which is the energy ETF. It's a simple, okay? Here, it made a low in December, but made a lower low. Wait a minute now. So crude oil is making a higher low. The energy stocks are making a lower low. Well, what do the energy stocks really trade off? They trade off, they follow the price of oil. It's not the other way around, okay? So we knew that this divergence was a great buying opportunity, and we came in and bought the you-know-what out of the energy stocks we bought, and that worked out really, really well, okay? But what we then what we did later in the as we got into mid-April, I said, okay, we're going to walk away from these. We're not going to chase them anymore. Look how overbought the thing got. This is the XLE got really overbought. So we walked away. Sure enough, the group came down, and once we worked off that overbought condition, we've moved back in just literally in the last week or so, just a little bit more than a week. We've gotten back into the group, and we use key stop levels that we'll be using. There's one stock that I just picked, Schlumberger, the old Schlumberger SLB. So these are the types of things we're talking about all the time. What's going on in the bond market, though? We have a very serious issue with the obviously with the budget deficit. Just one sec. With the budget deficit, and it's just getting worse and worse. And it's funny, people have been saying, 30, 40, 50 years that this could become a problem, and it never has. But now we're starting to see some real issues because we're seeing movement in the dollar and the currency in the markets, and people are becoming a lot more concerned because there's no way around the fact that we are going to be we are going to be selling, these billions to hundreds of billions, trillions of dollars worth of government securities. Somebody's got to buy them. At some point, the supply-demand issue is becoming a problem. We also have corporate debt that's all rolling over to over $10 trillion. Are going to roll over in the next year or so. So we've got a lot of headwinds. And so we're going to be watching liquidity in the marketplace. We're going to be watching those fundamental stories and how the data comes out. But these people who think that the market's just going to go straight up from here, I think are going to be we're going to see a few hiccups on the way, and we're going to be able to take advantage of those.
All right, and really quick, so if you're in the Zoom chat, stay here. Obviously, if you're watching this, let's say in another platform, just know we're gonna move everything here into the Zoom. So just make sure that you're here on the Zoom call, because this is where we're gonna carry on the remainder of the session. So, Matt, now a couple of other things here. What's the deal with NVIDIA with semiconductors overall? I mean, that's pretty much pulling up the markets. Do you think this is going to keep going for how long, possibly? I mean,
well, I mean, the one thing that the concern is that, yes, a lot of people are pulling up the big who are buying, they're buying the chips, they're buying the picks and the shovels to help them make money, but they're not making money yet. It's just the ones selling the picks or the shovels, the people selling the chips, the semiconductors. And so we need for that to widen out. And even though people are spending that money, not enough people are finding the gold, I guess is my point, yet. And I think I worry that the thing's going to be a lot tougher for that to be translated into a lot better earnings for a lot more companies. We're just not seeing it yet. And NVIDIA, people don't even realize NVIDIA has done nothing for almost 3 months now. Right? Maybe that's just a nice breather before it goes a lot higher. That would be very good. But they report their earnings in next week, and it's going to be incredibly important because we have a situation where you have a couple things. Number one, remember what happened last year when they reported in May. Reported great numbers, and the stock rallied and just kept on going. But then in August, they reported just as good earnings, if not better, and yet liquidity in the marketplace was starting to drain out, and so instead of the stock going up, it actually rolled over and went down 20%. And of course, the overall stock market corrected 10%. Will that happen this year in an election year? It's not out of the question. There's plenty of examples in the past where the stock market has sold off quite. We've seen corrections. Again, you don't see big bad bear markets usually. Although I shouldn't say that. We've had obviously we're going through it in 2008, but that was the great financial crisis. So again, these things can happen. But the key right now is that well, let me see here again. What are we watching right now? This is the SMH. This is the ETF on the again on the chip group. Let's just do a thing here. Okay, now it's starting to get a little overbought, not crazy so, but it's getting a little overbought. But it's testing this key level, its highs from March. And can this thing break out? Is it going to be the catalyst that it was last year? Oops, well, I put the note a little too low, but you can see up at the 240 level. If it can break above 240, that's going to be really bullish. But instead, does it create a double top?